Hello investors, today is November 10th, 2016. I'm Grant, this is Gary. Adam's our third partner and we are Dynamic Wealth Management. We haven't done a video for about a month. That's because we were waiting for the elections to come through. They came through and the result was very unexpected, and the markets have had an unexpected result as well.
Yeah, talk about volatility and uncertainty. If you were watching what was going on election night, we had futures that dropped by about 800 points that night.
Yeah.
And the good thing, though, is if you woke up in the morning, then watched the market, it all bounced back and we went back into the green. And so we have some charts to kind of paint the picture, talk about it. Let's go and jump into things. All right, good to be with you folks. Let's go ahead and give you your update as of November 10th. Let's start out with some events. As always, we have the investments for breakfast that we do every Tuesday now, every 2 weeks. The next one is actually this next Tuesday, the 15th, and that is here in the office at 9 a.m. And then after that, right at the end of the month on the 29th, and again, very informal. It's about an hour long, and we give a market update. We talk about interest rates, a little strategy. We also have a formal seminar that will happen on January 10th, and that will be right here in our backyard in Sun City Grand, and that is more formal, where we go through exactly how we manage money, how we work with clients, and that is at 4 p.m. and we'd love to have you and your guest as well, anybody you'd like to bring along with you. Go ahead and call the office at 623-466-6060 to go ahead and set that appointment with Penny. Let's talk about key events. Obviously, the biggest event was the elections. We have been looking forward to this for some time, and I think we can all be on the same page to say that we will no longer have this situation, the back and forth that went on through the elections. But now what does that mean for us? Well, now we can focus on some other things that are pressuring the markets, and besides the elections, we would have to say that the next big thing on our list is interest rates. So this came out about a week and a half ago. The Fed did meet at the beginning of the month, and as you can see here in this article from Market Watch, basically the Federal Reserve is indicating to everybody that it sure does look like interest rates are going to be moving up in December. In fact, if we look at the probabilities, and this can be seen on the website cmegroup.com, there is now about a 71% chance that short-term rates will go up. Now remember, the Fed has direct control over short-term rates through the federal funds rate, through the discount rate, not necessarily on the longer-term end, but we have seen longer-term rates as well go up, and we'll talk about that here in a second. And in fact, I think Grant will bring that up. Other key events are we are getting through and just got through earnings season for many stocks, and this is an interesting chart that came out from bespoke.com, and basically it is showing the average one-day percent change of stocks in reaction to their individual earning report. And notice, if we look at this earnings season in comparison to others, it was actually a pretty good one. So overall, by the way we watched the market, we would have to say that earnings were actually surprisingly better than what had been anticipated. And so that's good news, obviously, longer term. When you buy stocks, what are you really buying? You're buying their ability to make money in the future. And that's exactly what earnings attempts to report on. So what sectors did the best? This is the earnings beat rate, also that came from Bespoke. And as you can see, industrials, financials, and technology actually did the best among the 10 or 11 sectors within the S&P 500. But the average for all of them was still pretty darn good beat rate of about 67%. How about real estate? This came out over the last couple weeks. And what this is tracking for us from the S&P Case-Shiller Index is the percent of these different housing, these different cities around the nation, and their percent bounce back from prior lows in the housing market. So for example, the one that is nearest to where it finished as far as highs last time in the in 2008 was San Francisco, meaning that they are 95% above those lows. So they're almost 100% from where their top was. How about Phoenix? About 63%. So we still have some room to get up there. So basically, one of the ways we look at this is that real estate is still moving forward, but we have some room before we hit the highs back in 2007. This is another way to look at that. Certain cities like San Francisco, obviously you can see here, is we are near or surpassing overall average prices that occurred back in 2006, 2007. Denver, very much ahead, but other cities like San Diego, obviously Phoenix, we still have some room to run up to where prices got up to last time. And if you look at the overall composite index, in other words, 20 of the largest cities around the country, we still have a bit of room to move up. So that gives us some indication that real estate still has some room here if we're looking at it from highs and low percentages. With that, I'll go ahead and turn things over to Grant that will talk about the stock market and what has gone on leading up to the elections and after the elections and where we see things going from here.
All right, well, let's talk about what is happening in the stock market, specifically this week being the election week. Let's talk about what's happening out there. So here's the S&P 500. Now, this is going back about 8 months or so. Remember, we had the big drop into February, and this is kind of the bottom that we had at the end of January, beginning of February. And since then, the market has been strong this year, and especially, look right here, over the last about 5 days, we've had a very strong move, and a lot of that has happened this election week. So let's, nearing all-time highs again, but let's jump in there and look at the few weeks before. So here's 3 weeks prior to election week. Now here's the Dow 30, up 2.5%. The S&P 500, right, up 1.1. Small caps up 0.5%. NASDAQ flat. Treasuries, short-term and long-term, were down. Gold up a little bit, US dollar up a little bit. So this is the 3 weeks before election week. Now here's election week. Look at this. Dow up 4%, S&P 500 up 3.75, small caps up 4.76, just under 5%, right? NASDAQ up 3.5. Now again, we've got some treasuries here that are down. Gold is down, and the US dollar is up. Now, these are the returns I want to talk about here. So if we go back and look, so here's the 3 weeks before, and here's election week. So again, a lot of this has happened since Trump has won. Very interesting, where many people, us included, were kind of telling the story that the market, every time that Hillary Clinton did well in a debate, the market would rally on that. And so the market, all politics aside, the market was basically saying that, yeah, if Hillary wins, the market was more comfortable with that. But now the market is giving us a different story. Donald Trump has won, and by so doing, the stock market is getting excited on that news. Now, we have seen treasuries get hurt and some things with interest rates, which I'll talk about here in just a second. But overall, the major indices are up based on the news that Donald Trump has won the presidency. Here is the interest rates. Well, really, it's treasuries, which are affected by interest rates. So here's the pricing on treasuries. Now, you'll notice this is going back to the beginning of May. We had a very strong rise in the value of bonds and treasuries, really from May until July. And that was because interest rates were going down during this time. And you'll notice that here, treasuries, really all of them, these are short-term treasuries all the way up to long-term treasuries, have been falling since July and are really falling now. And a couple reasons for that. One is that one of Donald Trump's main messages is that he wants to build up the infrastructure in the United States. And by doing that, that should bring inflation back again, which inflation is an enemy of bonds, especially long-term bonds. Now also, as Gary talked about earlier, the Federal Reserve there's a 71% chance, at least by the way it's pricing into the markets, that they will raise rates in December. So we are expecting that to happen, and by that happening, that's also pushing the values of treasuries down. So recently, a big drop in treasuries based on the expectation of inflation and raising interest rates as well. So what is our model allocations right now? How are we invested based on all this information? Well, we had a pretty big pullback here in our ratio. We almost got down to the yellow line. Now remember, if we would have got through that yellow line, we would have started to take defensive positions, but we didn't. We had a big pop during election week, which pushed us all the way back up. So we've got about a 4% cushion between where we are now and the yellow zone. So we would need to see about a 4% drop before we would take action and get defensive. We, again, just to reiterate, we are in the green zone, not by much, but we are in the green zone for now. The allocation being green means if you are a growth client, then you are 100% in risk on assets, equities, and no defensive. If you're a moderate client, you're at an 80-20. And if you're conservative, you're at a 60-40, right? So 60% being the equity side, the stock side, and 40% being the treasury bond defensive side. These are our allocations for now in the core ETF model. As far as our sector rotation model, remember we are only changing up our positions in the sector rotation model on a quarterly basis. So you'll see these positions here change January 1. We will re-rank our 16 sectors, 1 through 16, and we will kick out the ones that are beneath their 6-month moving averages, and we will take the top 8 best sectors coming January 1, and we'll hold those for a quarter, and we will continue to do that each quarter. So there has been some very good holds here. Healthcare especially has been really bouncing since the election news. That being said, we want to get our disclosures out there and let everybody know that we are not selling anything or making any recommendations. We are simply educating on the markets and what's happening out there. You should consult with your financial professional before making any large investment decisions. That being said, thank you for watching our video, and we will get another video out soon. Thanks for watching. Have a great day.